In this session, I'm going to talk about one of the stories of a largest financial holding company in US, the JP Morgan Chase, with respect to its London whale trades. This is the trade that has been this has been the trade which we are referring to, the London whale trades. And in that particular trade, JP Morgan has lost even to an extent of $6.2 billion. And we are trying to understand how the risk management failure, has actually resulted in this sized losses for JP Morgan Chase. As we know that JP Morgan is one of the, or probably the largest financial holding company in US, almost assets of close to $2.4 trillion, which indicate the size, and probably a lot of firms respect the JP Morgan Chase as an expert in risk management space, and especially with respect to this London Wales trade, which JP Morgan keeps arguing it as a hedging kind of a portfolio where the intention is to reduce the risk in case of credit events occurring. So it's more of a credit protection kind of an investment. So it has portrayed to the world that it is a hedging portfolio, but overall it was involved very heavily in the proprietary trading, and lot of operational risk related issues along with the market risk related stuff has occurred, which has resulted in a big loss on this portfolio. Just to have a quick overview of the same, see, in somewhere in 2005, what JP Morgan has done was it has separated one of its wings, CIO, Chief Investment Office, and it has created it as its own proprietary trading group. And this this group was given a charge, almost $350 billion excess deposits that are there, right? $350 billion excess deposits that were there with the bank. Investing these excess deposits was one of the major role of this particular group. And this group, to a large extent, they thought of investing this as a part of synthetic credit derivatives. So creating synthetic positions. So they wanted to invest in the synthetic credit derivatives, and even where the trading was more on credit default swaps, indices, all these kinds of instruments, especially fixed income exposure is what they are primarily looking at. And they even called it as SCP, synthetic credit portfolio. This is the name they have even given to this investment strategy. And what has happened is, over the period, the notional value of this portfolio has grown quite drastically over the period, right? That entire synthetic credit derivatives trading, they called it as a synthetic credit portfolio, and they started increasing the net notional value of the investment in that particular portfolio. So this portfolio was quite profitable, right, until probably 2011. Until the end of 2011, this portfolio was highly profitable. It made a good amounts right from 2008 onwards till 2011. Even in the notional value wise also, probably you could see something like around 4 billion earlier. It has gone to close to 51 billion in 2011, and probably by March 2012 itself, it has reached 157 billion. So there is a huge increase in size of the portfolio. One big thing what you could see is the size of the portfolio has increased tremendously during this period, and obviously if the size increases, there could be a lot of liquidity risk coming up. There could be lots of various other risks that can crop up. So overall, the risk position of the company or risk position of this particular investment or the risk exposure for this particular investment has increased quite drastically, because one, the size has gone up tremendously, and even the kind of derivatives that are getting invested, so they are all high risky kind of derivatives, complex instruments with no proper valuation mechanisms, and completely short term credit investments are typically being chosen for trading purposes. And because of that, though the size of the portfolio has been increasing, what was clearly observed is in 2012, because of huge risk positions that have been taken, the losses also started growing up. Initially, probably there was in Jan 2012, there was almost $100 million loss. In February 2012, another $69 million loss. And probably the biggest thing is by March 2012, there was even a $550 million loss. So overall, in this first quarter itself, there was an overall loss of $719 million, and probably by the time it reached May, it has become almost $2 billion, and June it has even touched $4.4 billion the loss, and probably by the end of the year, December 2012, it has even gone to $6.2 billion. So within no time, the losses have accumulated quite drastically because of the risky portfolio that has been taken. All this has resulted because of just a few things. In 2011, there was a gain, almost $400 million gain for the $1 billion investment that has been made. So it was purely a speculative trade, but there was a $400 million gain, and that has even increased the risk. So there was an instruction also to reduce its risk-weighted assets, but I mean that would reduce the regulatory capital requirement. But because of its synthetic strategy, it has purchased long credit derivatives. They did not reduce the risk-weighted assets, but they have actually increased the risk-weighted assets. So overall risk has gone up quite drastically for the company. So if we typically see the timeline wise, in 2008 when the portfolio was typically created, it was a new wave, new dimension, because the notional value within this period from 4 billion it has gone to 51 billion, and even there was a profit of 400 million. But the biggest thing came in December 2011 when they were instructed to reduce their risk weighted assets. They have increased their risk weighted assets by getting into the long credit derivatives position. So the risk was completely widened, and though the net notional value has increased in the first quarter, the losses started accumulating, and that is what has caused to a big downfall or huge losses being piled up as a part of the London Wales trade of the JP Morgan. The biggest thing that has are a few important observations that are coming out in this context is the reporting mechanism. First of all, now looking into some of the glitches in the process, valuing the credit derivatives, there were some issues until earlier. until probably 2012, until 2011, the mechanism that they have used for valuing the credit derivatives was generally the M2M, the marking to market mechanism, was primarily the midpoint. The price was chosen as the midpoint of the bid ask prices for that particular day. Midpoint of the bid ask prices or spread, bid ask spread prices, whatever is the spread, the midpoint of that was chosen as the mark to market value for valuing the credit derivatives, and it was more or less a better mechanism of the fair value also. To a large extent, it was more or less coinciding with the fair value measurement mechanism. But what this company has done in 2012 is, instead of using this word midpoint, they have made it as the most favorable price. Not the midpoint of the spread, but the most favorable. Depending on whether they have got into long positions or short positions, they have used the most favorable price for the day. So overall, the losses are getting the losses that were getting reported have gone down sizably, and that is where they are posting. They have posted to the authorities that their risk levels are comparatively lesser, so the capital requirements that they need to post also have to go down quite drastically. So this is one place where a proper valuation mechanism being tampered has created a brighter picture of the company, but at a later point resulted in piling up of the losses. And on the other side, this company, which was very effective in using the metrics for identifying the breaches and all that stuff, somehow they did not follow those limits, and even though the breaches are occurring quite drastically, they did not take any appropriate action. They actually relied very heavily on the 5 key metrics, but the biggest thing is, though they have computed them, they got ignored by the management. See, they have defined 5 metrics. One with respect to the value at risk limits. They have set VAR limits quite in a better manner. They have actually come out with a 4-day VAR, and the limit was set for that. But there were continuous breaches on this 4-day VAR. Not only for the CIO portfolio, but also even for the JP Morgan portfolio. But though the risk analysts were completely informing that the VAR portfolio has been extended, they were asked to come out with an alternate model for the VAR. And this alternate model, what it has resulted in is, it has reduced the VAR limit. It has reduced the value at risk by almost 50%. So the value at risk got reduced by almost 50%, means the company was allowed to take more and more risk, increase the risky positions. So the SCP, the credit portfolio, the limits got exceeded, and the synthetic credit portfolio, the limits got exceeded, and the risk levels were lowered to a very large extent. This was a very huge blow. Though they have used the metrics, they have constantly breached them, and there was a repeated breaching of all these limits. So the intention of the firm was downplay, showcase a very low risk, that the risk levels are much lesser. The risk limits they kept increasing, right? The risk limits they kept increasing. They have changed the calculation methodology here. The VAR calculation methodology has been changed. So you see that there are so many breaches, and the intention of all these limits is once a limit is exceeded, either the trading has to stop or some of these things should happen, but somehow none of these things happened. So the VAR limits were breached quite drastically, and they also had a metrics with respect to credit spread widening 0 1. Credit spread 0 1 limit, that the credit spread, if it crosses a particular limit, the trading has to stop. And what has been observed is almost 100% exceeding of this limit has happened in Jan, and even 270% exceeding in February, and almost 1000% exceeding by the time March April has come. So in spite of regular widening of the credit spread, and no action was taken to really put things in place or to really control these aspects. Similarly, they had one more metrics with respect to credit spread widening by 10%. That earlier one was by 1 basis point, which was exceeded quite heavily, but even 10% credit spread widening limit, it was constantly breached in March, but there was no action that has been taken for the same. And we also talk about stress loss limits, the losses occurring during the stressed conditions. Even they had a limit associated with that also. When the market conditions are very adverse, what should be the kind of limits which should stop any further trading? Though they were breached very heavily in March, no action plan was implemented, or no cautious approach, or no corrective action has been taken on those activities. And finally, they even had a metric with respect to stop loss advisories. It's a very interesting aspect, stop loss advisories, which talk about during a particular period or during a particular time, what is the maximum cap? What is the maximum cap on on what a single portfolio can lose? The maximum cap on what a single portfolio can lose during a particular time period. It's a slight different from the typical VAR mechanism. We are talking about the maximum cap here, but even this limit was constantly breached right from January to March, or probably after January 2012 onwards. There were constant breaches even on these things. And overall, what could very clearly be observed is there are so many deficiencies with respect to the risk management process. Though we consider JP Morgan as an expert in the risk management world, what we have seen with respect to this case study is there are so many deficiencies with respect to the risk management practices, because the risk metrics that were there, they were not valued, they were not given their due importance at all. And it has been always mentioned that whatever the risk metrics that were getting computed, they are overstating the risk. So they were, though there were breaches hundreds of times, it did not catch the attention of the bank personnel at all. They have dismissed all these statements that have been made. They have asked for computing the alternate models, and they have even simply said that whatever the risk matrix that are coming out, they are simple garbage, and they don't need to have any kind of relevance with respect to the strategies adopted by the bank. Even because of that, they have come out with calculation of a new VAR model, which had actually reduced the VAR by almost 50%, but somehow it was found more and more incompatible, so they had to go back to the original model itself. So that is one of the blunders that I have done during the period. And concentration limits by a regular mechanism itself, JP Morgan used to have concentration limits on all its investment portfolios. How much maximum can be invested in one single position? or probably if the size exceeds a particular amount, the investment in that particular positions will be typically stopped. Whereas with respect to CIO, no such limits have been created. So if there had been a limit, then probably the huge exposure or huge size increase in that particular SCP would have been controlled, and which could not have resulted in such a huge damage to the entity. And even the risk weighted assets measure was completely downsized, because the valuation mechanism, as we have said earlier, instead of considering the midpoint of the bid ask spread, they were considering the most favorable bid ask spread, which has resulted in the risk weighted assets values going down drastically, and then thus resulting in the risk exposure and the risk capital also going much and much lesser. All these things have resulted in a huge risk management deficiency at the organization, which has eventually led to a widespread failure of the organization, failure of that trade. And the other information was, even with respect to its regulator, right? There was a primary regulator for JP Morgan, which is OCC. OCC is the primary regulator for JP Morgan, which is Office of Controller of Currency. So even to its primary regulator, it did not inform, it did not give any kind of an information regarding the SCP, that credit portfolio, the synthetic credit portfolio that it has created. It did not give much information, the true nature, where it invests, what is the size of the positions, nothing, or even the increase in the notional value of the position. It did not give much of an information to the regulator. The biggest thing is, it had called this as a core credit portfolio. It has given a name while reporting it to the regulator. It had called it as a core credit portfolio, and it did not show what it is really investing in, what are its positions, what are its exposures. Only in Jan 2012 this information got revealed, especially in a value at risk report. So the size 4 billion, 51, 157, nothing of this sort has been informed to the OCC. The complexity of the investments or the complexity of the derivatives positions that it has got into, none of these things, the riskiness of the portfolio, the kind of positions that are getting invested in, the kind of leverage that is going in, all these things have been shielded from the OCC altogether, because while reporting the performance, it was reporting more and more of aggregated performance rather than specifying the performance of SCP in a separate thing. So SCP's performance actual details were completely hidden off compared to the other investment profiles, because overall it was being treated as an aggregated portfolio rather than a detailed one. And at any point in time, they were very clearly mentioning to the OCC that everything was fine, all is well. Though the losses have been starting 100 million in Jan 2012, 69 million in February, and probably though the losses have been increasing, they are painting a picture that everything is fine. So, from the regulatory perspective, they have completely hidden the things. They have misled the OCC. That completely the SCP's details were not disclosed, and they have painted a wrong picture to the OCC, which has resulted in the risk completely mounting up. And that is where finally, when the final thing has come out as a part of the Senate's subcommission report that has come in after the investment into the process, it was very clearly coming out that JP Morgan had got into the misleading or probably providing wrong information to the investors. Investors were misled, the regulators, the OCC was misled, the policy makers were misled, almost all the stakeholders were misled, even the public were misled by JP Morgan because the overall size was not conveyed, the overall risk profile was not conveyed, even the losses that were accumulating also were not conveyed, because right from the beginning we see that JP Morgan has been talking about this portfolio as a hedging portfolio, especially against the stress loss, especially against the stress losses protection in case a credit crisis is going to occur. And but at the same time they have been trading on a daily basis. Generally, if it is a hedging kind of a portfolio, we don't see that much of frequent kind of trades that are happening, but they are doing a daily trading because they were mentioning that the trading was based purely on a very long term basis, not on a short term mechanism at all. So, and it has been talking that it has informed the regulator. This information is known to the risk managers and everyone knew about the position, so everything is fine with the bank. But because of this misled information, it has very clearly come out that they were not able to prevent the huge losses in the beginning itself, which has resulted in almost a $6.2 billion loss on the overall portfolio at the London Wales trade. So, just a few risk management related failures could result in such a widespread negative impact on the reputation as well as the performance of the portfolios, bringing in huge losses into the financial system. So, understanding of these kind of case studies will really help in terms of bringing in proper risk management practices and procedures to ensure that the company is well protected against any kind of extreme events that are going to happen. If you have any further queries regarding this, you can very well get back to me by giving me a call on the number that I have given below, or you can send in an email at vamsidhar@pacegurus.com. Thanks a lot for listening to this session. Thank you very much.